2023 has been the year of multi-bagger stocks. There have been so many stocks that have run up more than 100%. And right now, if you talk to investors, the biggest concern that they have is, are these stocks overvalued? Have they run up too high? And will we see a correction? So in this video, we are going to analyze multi-bagger stocks. What are the factors that lead to a stock becoming multi-bagger, how you can pick multi-baggers in India, and then I will be talking to you about a few of the recent multi-bagger stocks and give you a view on if those stocks are or not. Obviously, this is not investment advice. We are just giving you a brief overview, and please talk to your advisor before you invest. But before we begin, please do not forget to hit the like button and hit the subscribe button if you want to see more such content coming out from Team Wright. What are multi-bagger stocks? As the name suggests, these are the stocks that bag you multiples of returns. So any stock that has grown 200% is a two-bagger. Any stock that has given 300% is a three-bagger, and a 10x stock is a 10-bagger. So stocks that grow in multiples are called multi-baggers by investors. Companies that exhibit multi-bagger returns in India exhibit certain distinct characteristics that leads to the exceptional growth potential. They could be coming up with these disruptive innovations that make them market leaders, or they are pushing the boundaries of what can be done, or bringing up groundbreaking products that fill up the market's need. Sometimes these multi-baggers are from monopolies and are market leaders with significant pricing power, which leads to high profits. Also, multi-baggers typically have very strong fundamentals, including consistent profits, low debt-to-equity ratios, and impressive earning per share. The strong fundamental health, along with the scalable business model, ensures sustainable growth over time. Additionally, experienced management teams with substantial promoter holdings drive efficient operations and strategic decision-making. Transparency and effective corporate governance are keystones that would solidify investor trust in these companies. So overall, innovation, financial strength, effective leadership are some of the key points which lead to companies in India becoming multi-baggers. What are the key factors that lead to multi-bagger returns? So we have identified 6 key factors that lead to multi-bagger returns. Number 1, most importantly, the company has to be small in size. Only a small company can grow in multiples. Second factor is a strong promoter holding. How good is the promoter running that business is a key criteria through which you can identify multi-bagger stocks. Thirdly, differentiation in the market as well as in the product is extremely crucial. Unique offerings and solutions to unadopted problems create competitive advantages. The revenue sources should be diverse and sustainable. The sustainability in business revenue and profits is what drives multi-bagger performance. You also have to look at the quarterly and the yearly performance numbers because those will give you a very strong indicator about the health of the business and the potential to become a multi-bagger. And lastly, low debt coupled with high returns can be a very effective metric that you can look at while trying to pick these multi-bagger stocks. While multi-bagger stocks give you a big potential for high returns, there's also significant risk in multi-bagger investing. The first risk is that if you want to, bet big on a multi-bagger, you have to, invest a large sum and invest into it for the very, very long term. And if you have allocated a large sum to a single stock, that amplifies the risk of investing in that stock. Secondly, while certain stocks might look extremely attractive, there could be economic bubbles, there could be value traps, which can be significant threats. While sometimes investors can get caught in price surges, there could be ultimately value loss. Thirdly, multi-bagger stocks come from the small stock segment, and there can be a lot of volatility that is inherent to these stocks. So if you are betting on these stocks, you have to be prepared for the volatility. There can be limits on the liquidity also. If you picked a very, very small stock, then you could be trapped in such scenarios where there could be upper circuits or lower circuits, which impede your ability to invest or exit these stocks. And lastly, we are betting on a very long-term growth. So obviously there is significant fear of failure. A company could look promising, but it could have certain factors that do not play out well for it, and there could be a big probability of loss as well. So this is why we have to be well assured of the risk that is out there in these stocks and make informed decisions. Now let's come to the interesting part of the video, which is looking at the current multi-baggers and understanding if they are overvalued or not. The first multi-bagger stock that we're going to talk about is IRFC. IRFC has got a lot of investor attention because of its multi-bagger returns in the recent times. We're going to do a breakdown of the business, its prospects, and valuation. In terms of the business, IRFC is a government company. It was established in 1986, and the government of India holds 86% of this business. It primarily finances acquisition of rolling stock, railway lines, electrification, other capital expenditure. The stock has rallied 430% in the last year, and the company has also announced a number of ambitious projects, like the plan to invest 1 trillion in acquiring new trains over the next year. But if you watch the earning report coming out of this stock in the last quarter, you would see that the Q2 FY24 profits saw a 9.5% decline, which has been the reason why there has been a significant correction in this stock, and the stock seems to be consolidating. Talking about valuations from here, you would see that, okay, in terms of the overall industry, IRFC definitely does not have an extremely high PE or a PB ratio. But if you match the stock's P ratio or PB ratios with the peers or the historical averages, you would see that the stock looks a little bit overpriced right now. Moreover, some analysts also believe that the stock has the growth potential already priced in with the 400% growth, and there is limited. Now let's talk about the Bombay Stock Exchange, or the stock BSE. BSE is India's oldest stock exchange, which got established in 1875. It provides a trading platform for equities, currencies, commodities, and its primary revenue drivers are transaction fees, listing fees, and the data services. It's a mature exchange, and its growth is likely to be steady and incremental. BSE stock price has also grown more than 400% over the last year. The company has been focusing on product offerings, including launching of derivatives on the SME platforms and introduction of new. However, there is significant competition from other exchanges as well as regulatory challenges. BSE has shown very significant sales and profitability growth as well in the last year. So while the stock price has run up and it's a high momentum stock, the potential growth factors and analysis from different analysts who are looking at the potential of BSE in the long term also remains extremely strong. Comparing with peers like NBCC, MCX, CDSL, the P ratios for BSE are definitely a little bit inflated, but like we said, the potential for the strong remains extremely strong. So the price could end up justifying the value. Let's talk about a third multi-bagger stock of the last year, which is JINDALSAW. JINDALSAW Limited is a leading manufacturer and supplier of iron and steel pipes and pellets in India and around the world. They have a very strong presence in energy transportation sector. They have manufacturing facilities in India, US, as well as the UAE, and they cater to various industries like oil and gas, power, water, and wastewater. There have been a number of interesting news about JINDALSAW, like recently it bagged a 2,000 crore plus orders for pipe supply to GSPL. JINDALSAW is going to invest 5,000 crore in expansion, and of course, the price of the stock has skyrocketed in the recent year. The prospect for the steel pipe industry is positive, driven by factors like growing infrastructure and demand for oil and gas. And JINDALSAW is well positioned to benefit from these trends. But if you look at the recent earnings that came out of JINDALSAW, the growth of sales slowed down and profitability is also a little bit low. On valuation levels, if you compare it with peers, you will see the P ratio for JINDALSAW is actually lower than its peers, and the price to book value ratio is also low. In the last year, the profit growth has also been extremely strong. So given that, I think JINDALSAW is well positioned to grow with the rising infrastructure segment, and the valuations are also not extremely expensive based on the next stock that we're going to look at is Vodafone Idea. Vodafone Idea, also known as Idea Cellular, is the third largest wireless operator in India. It is not your typical multi-bagger because it is in a very competitive industry. It has a lot of business challenges, But if you look at the stock price, the stock has grown more than 100% in the last year. Idea offers mobile voice, data, and enterprise services across India, but it operates in a highly competitive market with Jio and Airtel. The company has challenges in terms of high debt levels, low ARPUs, as well as network coverages. The company reported a negative profit growth and a very slight growth in revenues last quarter. The net debt levels for Idea are extremely high, which looks like a financial burden. Idea is actually exploring fundraising options to address these concerns. There's a lot of positives in the India's growing smartphone penetration and the expansion of the 4G and the 5G networks. However, there is also intense competition, regulatory changes, as well as the high debt level for the company that is a concern. Vodafone Idea has a negative P ratio, so it is difficult to compare it with its peers. Similarly, on the price to book ratios, the stock has a negative value. The stock is also not highly rated by analysts, but has seen a very sharp growth. So investors having seen these levels should be safe, should be vigilant about the stocks if you are planning to buy as a momentum. Now let's talk about our last stock, which is VBL or Varun Beverages Limited. Varun Beverages Limited is a company that has the franchisee of bottling and distribution of PepsiCo's beverages in India. It is the largest PepsiCo bottler in India and largest in the world. It has strong market position and has seen significant growth in the last few years. If you look at the stock charts, you will see VBL has grown more than 100% in the last 1 year in a very steady fashion, and the trend continues to be strong. VBL has bottling plants for all the PepsiCo beverages like Pepsi, Mountain Dew, Miranda, Tropicana, Aquafina. It also has its own private labels like Appy Fizz and Bisleri. There's a very strong brand portfolio, extensive distribution network, and efficient manufacturing capabilities. The stock has also given a very strong financial performance, growing to 24.5% and net profits rising 32.6%. VBL is expanding the product portfolio, distribution network, and entering new markets and launching new products. We also see India's beverage manufacturing industry grow at a CAGR of 11% in the next few years, and VBL is well positioned to gain from this growth. If you look at the valuations for VBL, you will see it is slightly overvalued in comparison to its peers, both in terms of the P ratio as well as the PBV ratios. Still, it is one of the biggest player in its space by a margin, and it has very strong sales and profit growth. Given the strong prospects for PBL and its strong market presence, the valuation premium that the stock is seeing is justifying the growth potential. And as we can see that the trends continue. That was our video on multi-bagger stocks. Multi-bagger stocks are the exceptional stocks with strong growth potential, great market position, strong management quality, financial health, industry tailwind working for them, and big scalability. Obviously, they come with their own unique set of risks, being smaller in size and having inherent volatility. Like we said, it is always important to also look at the valuation of the stock before you invest just based on the trend. And I hope this video was helpful in evaluating that. If you like this video and would like to see more such content from us, please do hit the like button and subscribe on our channel. We'll see you in the next one. Till then, happy
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to